Alright, hi everyone. Welcome to today's pre-market live analysis brought to you by IC Markets. I trust you've had a great weekend, spending some quality time with your family and friends, and recharging over the weekend as well, right as we begin the brand new trading week. Alright, before we begin, right, I think we're all good to go on the audio and video. Alright, before we begin, please take note of the disclaimer. Right, this is marketing communication. It does not contain and should not be construed as containing investment advice or an investment recommendation or an offer of or solicitation for the transactions in financial instruments. Also, take note of the risk warning that comes with trading forex and CFDs as they carry a high level of risk to your capital, and you should only trade with money you can afford to lose. My name is Ketan Rameshchandra, and this webinar series is brought to you in a special partnership between IC Markets and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years 2019, 2020, and 2021. Right, before we dive into the charts trading view, let's take a look at what's coming up on the economic calendar for this week. Right, we've got Australia's CPI data coming up on Wednesday, 26th of February, followed by US GDP data on Thursday, the 27th, and finally with the US PCE price index dropping on Friday, the 20th of February. Now, the PCE price index is the personal consumption expenditures index and is the Federal Reserve's preferred gauge of inflation, so we're going to be keeping a close eye on this on Friday. Right, so here's a calendar for this week. So among those three items that I had listed, there's quite a few other things going on as well. Right, on Monday today, 24th of February, we've got the German Eye for Business Climate. And tomorrow we've got a few US macroeconomic data points as well. We've got the S&P Case-Shiller Home Price Index, Consumer Confidence, and the Richmond Manufacturing Index as well. On Wednesday, we've got Australian CPI, right? Keep an eye on that. We also have GDP data for Switzerland, as well as Tokyo Core CPI for Japan. Of course, US GDP coming out on Thursday, 1:30 p.m. as well on Friday. And finally on Friday, not only do we have the PCE price index, we also have GDP data for Canada and CPI data for Germany as well. Right, so quite a few things going on besides the three events that I had highlighted. Right, sure, we'll definitely cover Bitcoin and Aussie as well, right? As usual, we'll start off the analysis with the dollar index, work our way through a couple of the major currency pairs, the commodities indices, and definitely we'll be touching on Bitcoin as well. Alright, hi Jamilu. Alright, hi everyone, great to see you. Thanks for tuning in. Right, taking a slightly closer look at inflation in Australia, right? Looking at the monthly CPI indicator, right? The data that will be released on Wednesday, 26th of February at 12:30 a.m. GMT, right? Take note, all the times that are listed here are on GMT time. And we are expected to see monthly CPI accelerate in Australia, right? We've seen since dropping as low as I believe 2.1% in September and October of last year. We've seen the monthly CPI indicator accelerate for 2 consecutive months, rising as high as 2.5% at an annual rate of 2.5% in December of 2024. And this acceleration looks to gain further traction as we expect January's figures to increase to 2.6% as well. Right, part of this this is also December's figures was the highest level since August, and at the same time, this is partly due to the fact that the effects of the energy rebates have started to wane as well. Remember, with energy rebates waning and energy prices, particularly crude oil, increasing right at the beginning of the year, this has had an impact on overall inflation as well, and that is why it's very likely January's figures are going to accelerate to 2.6% in the latest reading. And of course, should we see the result come in higher than market expectations, right, this could trigger a near-term boost for the Aussie, right? So we could see demand for the US Australian dollar pick up quite strongly on Wednesday, especially if CPI data exceeds the market forecast of 2.6%, right, which which is something that's quite likely as well, given how energy prices have increased in the recent months, as well as factors such as the energy rebates waning in Australia as well. That could have a huge impact on upward inflationary pressures in Australia. Right, moving over to US GDP. Right, US GDP will be released on Thursday, 27th of February. That's at 1:30 p.m. GMT time. Right, so looking at an annualized rate, right, year-over-year rate. Economic activity has expanded 2.5% in the fourth quarter of 2024. Pretty decent increase as well, right? This is based on the advanced estimate. However, you can see economic output has somewhat moderated, slightly lower in the second half of 2024, right? After rising as high, after expanding as much as 3% in the second quarter of 2024, we've seen economic output moderate slightly lower, right? On a quarterly basis, right, we've seen the second and third quarters of 2024 show strong output, right? After moderating significantly lower in the first quarter of 2024, right, we've seen economic output jump in the second and third quarter, right? And then at a quarterly basis here, right? So a strong rebound in economic output, but once again, we can see the fourth quarter data sliding lower, right? Moderating lower down to 2.3%. Now looking at this was all based on the advanced estimate. Now looking at the preliminary estimate, right, for the same quarter, we're expected to see GDP output, right, remain unchanged at 2.3%. So nevertheless, still a pretty decent output, which is driven primarily by personal consumption, right? Personal consumption continues to remain as the main driver of growth, right, increasing the most since the first quarter of 2023. Right, so if you do see robust economic output, right, or steady economic output, this could create demand, right, trigger demand for the US, higher than expected demand for the US dollar as well. Now, and finally, on Friday at 1:30 p.m. GMT time, right, the PCE price index will be released, right? This is the personal consumption expenditures index, and this is the Federal Reserve's preferred gauge of inflation, right? When we look at headline PCE, which is the chart on the left, and then when we look at core PCE, which is the chart on the right, we can see the headline figure has accelerated since September, right? After moderating as low as 2.1 to an annual rate of 2.1% in September, we can see that headline PCE has accelerated as high as 2.6% in December, right? And remember, while the core reading has remained unchanged at 2.8%. Now, despite the core reading remaining unchanged, it still sits well above the Fed's target of 2%. And you can see here, right, the core reading excludes high volatility categories such as food and energy, and that's being reflected here. So you can see very clearly the increase or the acceleration in headline PCE is primarily driven by energy costs and food costs as well. Right, remember the core reading, which is the chart on the right, strips out food and energy, right, the higher volatility items. Hence, it has remained relatively stable, but you can see the acceleration in headline PCE. Now, looking at a monthly basis, right, there's no estimates as of now. For the other metrics, right, we have core PCE at an annualized rate, core PCE at a monthly rate, headline PCE at an annualized rate, and headline PCE at a monthly rate. So far, we only have the forecast for core PCE on a monthly rate, and that's showing a slightly stronger output than the previous month, right? So 0.3%. So once again, if we see PCE or the PCE price index show inflationary pressures returning to the US, right, this is quite likely going to trigger another round of demand for the US dollar as well. Alright, okay, so with that, now let's move on over to the charts and trading view and begin the analysis. And of course, we'll start off with the dollar index, right? Start off with the dollar index, and then we'll work our way down through the Aussie, a couple of the other major currency pairs. We'll touch on commodities, then we'll go on to Bitcoin, Ethereum, and we can touch on the indices as well. And of course, any other, and should you have requests for any other instruments, please do drop your requests in the chat box here. I'll be more than happy to go through the analysis with you. Alright, so starting with the dollar index, right, we're on the daily time frame here, right, and we can see on a weekly basis, right, we quickly switch over to a weekly basis on the weekly time frame. We can see demand for the dollar has significantly waned since mid-January, right after hitting a high of 110.17. The dollar index has tumbled significantly lower, right? I think it has dropped, let's see, from peak to trough, right, as much as 3.5%, right? From peak to trough, it has dropped as much as 3.5% since mid-January, right? So, and in the more recent weeks, right, we've seen it decline for 3 consecutive weeks. So you can, clearly demand for the dollar is faltering, and that has caused the dollar index to drop quite strongly as well, to drop quite sharply, right? And we can also see that it's like, especially since the beginning of February, right, we can see that this index is trading in a series of lower highs and lower lows, right, extending the downtrend here. Now, however, last Friday, right, we saw demand for the dollar return, right, especially after the sharp sell-off on Thursday, 20th of February, right. Friday, we had a combination of weaker earnings being reported by Walmart, right. Walmart is a huge uh, consumer related stock, right? And at the same time, we saw the White House announce a new round of trade tariffs as well. So because of that, we've seen demand for the dollar return quite strongly on Friday, 21st of February, causing the dollar index to stabilize at around 106.40 to rise as high as 106.75. So we've seen managed to see the dollar index close in the green uh, last Friday on the 21st, and perhaps with this new round of tariff measures being announced by the White House, we could see demand remain intact and perhaps see the dollar index make a retracement to the upside. So take note, right? We've had a new round of trade tariffs being announced by the White House on Friday, creating or reigniting some demand for the US dollar. Now, whether this is going to reignite really strong demand is something that needs to be seen over the next couple of days. But perhaps as markets reopen in about 45 minutes, right, we can probably expect this continuation to rise, to remain intact, and that could potentially cause the dollar index to rise up towards the pivot. Now, the pivot at 107.49 is an overlap resistance. And we can see that previously this level functioned as a nice swing high resistance at the end of November, and after that we can see it function as a pretty decent support on the 20th of December, another pretty decent support here on 24th of Jan. Of course, this candle here on the 27th, right, of course this candle here on the 27th breaks significantly breaks lower, right, breaks noticeably lower beyond the overlap support, but nevertheless this level has held up as a pretty good support level on the 30th of January, and then again on 6th of February. And of course, once the bearish breakout took place, you can see this retracement here that occurred midweek last Wednesday, 19th of February, ran into resistance close to the pivot as well. So the pivot at 107.49 is actually an overlap resistance, right? It's an overlap resistance. It's also accompanied by Fibonacci retracement at 38.2%. Right, we found this 38.2% retracement starting from this swing high here on 3rd of February and going down to the swing low of last Thursday on the 20th. We can see that the 38.2% Fibonacci retracement sits just above the overlap resistance, which is the pivot, and also we can see the 61.8% Fibonacci retracement sit pretty close to this swing high resistance that has taken place here on Tuesday, 4th of February, and that's at around 108.67. Right, as I mentioned as well, right, we can probably identify a pretty decent bearish channel as well, right, as we can clearly see a series of lower highs and lower lows, right. Hang on, this should be looking for bearish channel. There we go, and just let me highlight the background a little bit. Right, so you can see a couple of touches to the upper trend line of the bearish channel, and just one touch for now on the lower trend line, right. So you can see it's sort of like a bearish channel in the making, but perhaps it's more of a descending trend line, right. It's more of a descending trend line. So let's just draw this as a descending trend line. Right, so take note, right, probably we can expect demand to to remain intact as Monday, as markets reopen today, right? And perhaps we can see this retracement in the dollar index to gain further traction, right? And especially if it can break above this descending trend line, then we can probably expect the dollar index to rise up close to the pivot, right, or all the way up to the pivot, which is an overlap resistance. Now, we also talked about the first resistance, right? That's a swing high resistance at 108.65. Now, what about support, right? We can see here when we look at this level at 105.44, I actually can see a very nice overlap, right? We can see that this level previously functioned as a little bit of a resistance on Wednesday and Thursday, 6th and 7th of November. And then once the bullish breakout took place on Monday the 11th, we can see this level functioning as pretty good support. We can see here, we can argue here as well on the 29th of November, dollar index stabilizing above 105.60. Then of course bouncing up this level very clearly on Friday, 6th of December. This creates a nice overlap level at 105.44, which we can identify as the first support, and is also accompanied by a Fibonacci retracement at 50%, right? We found this retracement level starting from this swing low here on 27th of September and ending with the swing high on the 13th of January. We can see that the 50% retracement sits pretty close or just underneath the overlap support at 105.44. So just to recap for the dollar index, right? We could see this index retrace a little bit higher as markets come online in about 40 minutes, right? And take note of this descending trend line. This is going to be pretty key as well. If we do see this descending trend line give way, right, if the dollar index can break above the descending trend line, we can then have a little bit more confidence or higher level of confidence, higher degree of confidence that this index could reach the pivot. And this is where it could stall once again. From the pivot is a pretty significant overlap resistance accompanied by a Fibonacci retracement at 38.2%. Alright, now let's move on over to the Aussie, right? Take a look at the Aussie and then we'll touch on the Euro and dollar yen. Okay, looking at the Aussie, right, we can see since Monday, 3rd of February, right, we can see the Aussie stabilizing around 61.40 a couple of times, right? We see the first time it stabilized at around this level was in mid-January, and we see the Aussie stabilizing at the beginning around this we see the Aussie stabilizing around this region once more at the beginning of February, and since then it's rebounded quite strongly, right? From trough to peak, it has risen as much as well over 5.3%, and this is despite the RBA, right, the Reserve Bank of Australia, reducing its cash rate last week, right? So the Reserve Bank of Australia, I believe, moved ahead with its first rate cut on Tuesday, 18th of February, right? If I'm not mistaken, it was a Tuesday, 18th of February, where the RBA, right, Australia's central bank, made a reduction in its cash rate, right? Made a 25 basis point reduction. However, we've actually seen demand for the Aussie remain elevated, right, despite that rate cut taking place. Now, last Friday, 21st, we saw demand for the US dollar pick up strongly, and that naturally is going to cause the Aussie to pull back quite sharply, right? We can see this is a pretty big drop, right? I think just Friday alone from peak to trough, this is as much as 0.9% or more than 55 pips here, right? Pretty big drop on a single day, right? And we've seen this is primarily due to, right, the new announcements and the new trade tariffs being announced, right? New trade tariffs measures being announced by the White House last Friday. Now, looking slightly below, right, actually I see a nice pullback level at 63.13, right, a pretty decent pullback level which has been identified as the pivot, and is also accompanied by the Fibonacci retracement at 23.6%. So this retracement level was found starting from this swing low on the 3rd of February going up to the high of last Friday on the 21st. Now when we look at this level here, right, you can see previously as the Aussie was retracing higher, right, as the Aussie was retracing higher from mid-January till the end or till the 3rd week of January, it stalled at around 63.30, right? You can see it's running into resistance here, making a swing high resistance, dropping back towards 61.40, stabilizing off this support level once more before finally rising higher and breaking above the prior swing high resistance. Now once a bullish break takes place, This prior swing high resistance can likely function as a pullback support, which has been identified as a pivot, and it's also a level that's accompanied by the Fibonacci retracement at 23.6%. Right, so we're looking for the Aussie to pull back towards the pivot, which is a pullback support level, right? And this is where I think the Aussie could once again stabilize and perhaps make another rebound and continue the uptrend towards 64 cents. You can see it pretty much failed at the 64.7 mark, right? Just slightly breaking above 64 cents and stalling at around 64.10, right? So once again, should we see the Aussie pull back towards the pivot and stabilize around this region once more, we can probably expect a nice bullish bounce and see this currency pair make another attempt to break above the 64 cent mark. Now beyond that, the resistance there's a resistance at 64.49 or pretty much at 64.50. This is a pretty decent overlap resistance, right? We can see this is a pretty decent overlap resistance. We can see that previously back in mid-November, we can see the Aussie bouncing off this level not once, not twice, but 3 times, right? Forming a pretty solid support here from mid-November till the beginning of December. But of course, we can see the Aussie breaking lower in the first week of December, and after that, this level proceeded to function as pretty decent support, as pretty decent resistance on Monday, 9th of December. So this creates a pretty good overlap level that we can identify as the first resistance, and that's at 64.48. And of course, the first support is this multi-swing low at around 61.40 cents, right? Right, we can see this strong swings, multi-swing low support being in place since 10th of January, and of course rebounding strongly in the first week of February as well. So very strong multi-swing low support at 61.44, which has been identified as the first support for the Aussie. And take note, we can see that it pulled back very sharply last Friday, and this pullback could continue as markets reopen today, right? And should the Aussie stabilize at around the pivot, it's we are likely to see it reverse and make a strong rebound and make another attempt to climb above the 64 cent. All right, now let's move on over to the euro. Taking a look at euro, and then we'll jump over into Bitcoin, right? Bitcoin and Ethereum. Then we'll come back to the commodities, right? So looking at the euro, right? Of course, with demand for the US dollar returning on Friday, right? Of course, it would cause the euro to pull back as well. We can see that since the end of January, the level at 1.0520, right, at about 1.0520 20 and 25, right, has functioned as a very strong resistance barrier. We can see that the euro has failed to break above this level couple of times, right? We can see very clearly on 27th of January, then we see it failing once more on 14th of February, and last week as well we can see that it came pretty close to this barrier before fizzling out as well. So this is almost like a multi-swing high resistance at 1.0520, which we have identified as the first resistance. And not only is it a multi-swing high resistance, it's also accompanied by Fibonacci retracement at 50%. Right, so we found this retracement level starting from this swing high on 6th of November, going down to the swing low here on Monday, 13th of January. Right, so we have a pretty strong resistance barrier, right, being identified by a multi-swing high resistance at 1.0520, and which is accompanied by Fibonacci retracement at 50%. And also at the same time, right, we can see the index, we can see the euro, trading within the red Ichimoku cloud, right? It's sort of highlighting when the cloud is red in color, it highlights the ongoing bearish momentum, and the cloud itself can function as an area of resistance, which is something that has occurred on 27th of Jan and as recently as mid-February as well. Right, and so of course with demand for the US dollar picking up last Friday, right, then we've seen the euro pull back quite sharply, right? Even this is a pretty strong pullback from peak to trough, slightly more than 0.5%, right, about 55 pips, right? Pretty big drop for a single day. and is falling towards what I see is a nice overlap, right? 1.0402 is a nice overlap support. Why do I say that? Right, previously this level functioned as resistance here in the first week of February, and then when the bullish breakout took place here on Thursday 13th of February, it it would proceeded to function as support, right? So once the bullish breakout takes place, a prior swing high resistance can potentially function as a pullback support, which it has did quite nicely here on 19th of February, making a nice rebound here, thus creating an overlap level. So 1.0402 is an overlap support that's also accompanied by 50% Fibonacci retracement. Right? So we found this retracement level starting from this swing low here on 10th of February, going up to this high on the 14th, and we can see that the 50% retracement aligns very well with the overlap support, which is the pivot. And beyond the pivot, the next support is a nice swing low that was formed on the 10th, and that's at 1.0293, right? We see a nice swing low being formed here, right? And that's where we've identified the first support. So look, once again, similar to the Aussie, we are looking for a potential bullish bounce for the euro, right? Should it drop all the way down towards the pivot, this is where we can expect it to stabilize and perhaps make a potential bullish reversal and make another run towards the first resistance at 1.0521. So similarly to the Aussie, we're looking for a slightly deeper pullback where each of these currency pairs could stabilize at their respective pivots and make a potential bullish reversal to resume the uptrend. Right, even for the Aussie, right, if you look at it since, I would say, yeah, probably maybe from the first week of okay, maybe not from the first week of February, but from here, from the second week, right, we can actually also spot a pretty decent ascending trend line, right? It's also a pretty decent ascending trend line to take note of. Right, this ascending trend line has been in place since Monday 10th of February. So the combination of the ascending trend line, the pullback support, which is the pivot, and 23.6% retracement could identify a pretty strong support zone. And for the euro as well, right, for the euro as well, we can probably also identify a pretty decent ascending trend line, right? We can see here, right, this ascending trend line capturing the lower tails of the candles on 11th of February, and even here as well, you can argue on the 19th as well. So we have the combination of the ascending trend line, the pivot, which is an overlap support, and the 50% Fibonacci retracement, identifying a pretty strong support zone where we can expect the euro to stabilize and perhaps make a potential bullish reversal to resume the uptrend. Alright, so we've covered dollar index, the Aussie, the euro. Let's touch on dollar yen, and then we'll move on over to the cryptocurrencies. Right now, looking at dollar yen, right, we've actually seen demand for the yen increase quite significantly since 10th of January, and when we look at it on a weekly basis, and we can see that this has been a pretty strong reversal, pretty strong bearish reversal, and this currency pair has dropped from peak to trough, has dropped well over 6%, nearly dropping 6.3%, or nearly dropping as much as 1,000 pips here over the last since the second week of January, right? So demand for the yen has picked up quite strongly as inflationary pressures remain persistent in Japan, which raises the probability of another rate hike by the Bank of Japan, right? So we've seen pretty decent economic output while inflationary pressures continue to persist in Japan, creating an environment where market expectations are looking forward for perhaps another rate hike by the Bank of Japan. Hence, we've seen the yen appreciate quite significantly, and when the yen appreciates, currency pairs like the dollar yen are going to move in the opposite direction. We can see right very clearly since the second week of January, the dollar yen has fallen over 1, 2, 3, 4, 5, 6 consecutive weeks, right? And out of these 6 weeks, sorry, has fallen for 6 weeks. And out of these 6 weeks, we've seen 5 weeks of very strong declines, right? 5 very strong weeks of declines for the dollar yen. Now, coming back to the daily time frame, right, we can see since 13th of February, dollar yen has dropped very sharply as well, right? Highlighting the ongoing strong demand for the Japanese yen. right? So remember, take note, stronger demand for Japanese yen is going to cause currency pairs like the dollar yen, pound yen, and euro yen to drop lower, right? And it looks like the dollar yen appears to have stabilized last week at an overlap support, right? The pivot at 149.28 is an overlap support, right? It looks to be a pretty significant one as well, right? Because previously this level here at 149.28 functioned as a swing high resistance in mid-August of last year. See a little bit of resistance here as well in October, and then once the bullish breakout took place, we see support being formed in this second half of October. So this then creates a nice overlap support level, which the dollar yen managed to stabilize once more, and in the beginning of December as well. As you can see very clearly, this is a very significant overlap support, right? Especially with this swing low taking place here in the beginning of December, and this is where it looks like the dollar yen does seem to have stabilized last Friday as well. Now, if demand for the dollar continues to remain strong as markets reopen, right, we can probably expect the dollar yen to make a small rebound, right? Remember, probably not expecting it to make a very sharp bounce, but perhaps make a small rebound off the pivot, right, which is a significant overlap support. Right, remember the downtrend for the overall trend for the dollar yen is to the downside, right? Is to the downside. We can clearly see, right, descending trend line being highlighted, right? This descending trend line has been in place since Friday 10th of January, and we can clearly see a series of lower highs and lower lows as well. With that said, right, with demand for the dollar picking up last Friday, right, that could probably provide some stabilization for the dollar yen as well. Perhaps you can see the dollar yen stabilize around the pivot at 149.28 and make a small rebound as well, right? In terms of resistance, what was previously a swing low support, right? We see a nice swing low support being formed here in the beginning of February, with dollar yen stabilizing at around 151.30 before reversing to make a nice retracement to the upside before stalling just under 155, and then reversing once more to the downside to extend the downtrend. So what was previously a strong swing low support, right, and actually we can see support being formed once again in mid-February, right? And then once this level gives way, or it gave way last Thursday, what was a pretty decent support level can now potentially function as resistance. So the first resistance at 151.23 is a nice pullback level that's also accompanied by a Fibonacci retracement at 38.2%. Right, so this retracement level was found starting from this swing high here on 12th of February, going down to the swing low here of last Friday on the 21st. So take note, this retracement is only going to be valid as long as the dollar yen stays above 148.92. Take note that if it does drop below 148.92, in the sense that it makes a newer low, right, or it makes a fresh low, then of course this retracement at 38.2% is no longer valid. But for now, right, it looks to be still intact, and as markets reopen, please take note, right, if should we see the dollar yen break below 148.92, that means this retracement is no longer valid. We'll probably need to readjust it, or perhaps just delete it from the analysis. Now beyond the pivot, which is a significant overlap support at 149.28, there's another nice pullback level at 146.90. Right, previously this is another swing high resistance that was formed on September of 2024, right, as dollar yen was falling sharply over this period in August and September. It made a small retracement to the upside before stalling at around 146.90 to resume the downtrend. However, once the bullish breakout took place, right, there's a strong bullish breakout that took place in the beginning of October. So what was previously a swing high resistance can now potentially function as a pullback support, and this pullback support is also accompanied by a Fibonacci projection at 100%. Right, so this projection level was found starting from point 1 on 10th of January, going down to point 2, which is on the 7th of February, and ending at point 3, which is on the 13th. And we can see that the 100% projection sits pretty close, or sits very well, with the pullback support at 146.90, which is the first support here. So take note, we can probably expect dollar yen to stabilize at around the pivot the pivot at 149.28 is a very significant overlap support, and especially right if demand for the dollar continues as markets reopen today, right, we may see the dollar index retrace a little bit higher, and that would be something that could cause the dollar yen to stabilize and probably lift up together along as well. Right now, let's move on over to Bitcoin, and we'll touch on Ethereum before moving over to the commodities. Right, looking at Bitcoin, right, we can see that after making its most recent intraday all-time high at about $109,547, right, this was formed on 20th of January. Since then, right, Bitcoin prices for Bitcoin have slid lower, right. You can see this coin has sort of remained restricted under the $100,000 mark since the first week of February, and has stabilized at around 94,700 since the 9th of February as well. It's sort of just ranging between between these two levels here, right? Right, we can see right hang on. Right, Bitcoin just sort of ranging between these levels for now, right, being supported in the near term at around 95,000 and running to resistance at around 100,000 here, right. In terms of the first major resistance, there's this swing high here that was formed on 4th of February. That's at $101,963. And in terms of the support, there's a very significant overlap at 91,855, right. This is a significant overlap support that has been identified as the pivot, right. So and the resistance is also accompanied by a Fibonacci retracement at 61.8%. We found this retracement starting from this swing high on 20th of Jan, going down to the swing low here on the 3rd of February. That's how we found the 61.8% retracement, and it accompanies the first resistance pretty well. Now the pivot at 91,855 is a very significant overlap level. This level previously functioned as resistance here in mid-November, and then we can see it functioning as a very strong support multiple times. Right, we see a nice swing low bounce being formed here on the 26th of November, another bounce here on the 6th of December, another one here on the 20th, 23rd, and 31st December as well, and in January as well on the 9th of Jan, 14th of Jan, and as well as recently as 3rd of February. So you can see very clearly a very significant overlap level and 91,855, which has been identified as the pivot. Now beyond this pivot, right, or beyond this overlap, we can see there's no other major real support, right. You can see there's a pretty big gap here between the pivot and the first support, because when you look at the market structure between 6th of November till the 20th of November, we can't really identify any major support levels, right. There's no real significant pullback or overlap that we can identify, or even a swing low. What we are relying on is this pullback level here at 73,240. This level previously also a very significant resistance barrier for Bitcoin in March of 2024 all the way till pretty much of 2024, all the way from March of last year till November of 2024. You can see that this level functioned as a very significant multi-swing high resistance, right. You can see the first swing high resistance being formed on 14th of March, then again on 8th of April. You can even argue here there's a swing high resistance on 20th of May, and then again on 6th of June, and finally the last one here on 28th of October. See a very clearly a very significant multi-swing high resistance, which finally got taken out, right. We saw a nice bullish breakout take place in November of last year, triggering a very strong bullish move, triggering a very strong run or rebound or rally for Bitcoin. So what was previously a multi-swing high resistance at $73,240 is likely to function as a pullback support level. So that's how the first support has been identified. But take note, between the pivot, which is itself is a significant overlap level, and the first support, the pullback, right, there's no real support that we can identify based on the market structure here. And this pullback support at $73,240 is also accompanied by a Fibonacci extension at 161%, right. We found this extension level starting from by running a retracement starting from this swing low here on 13th of Jan, going up to the swing high on the 20th, and that's where how we identified the Fibonacci extension at 161%. And take note, right, if we zoom in a bit on Bitcoin, and if we look at it since the second week of February, we can see it has pretty much just gone sideways, right? It has managed to stabilize at around 94,650 on the lower end, and has remained restricted underneath the 100,000 mark here as well. So take note, it's sort of just trading sideways within this channel here since 6th of February. Right now, should we see Bitcoin break out of this box, right? Should we see it break out of this sideways channel? It is very likely going to stabilize at the pivot, which is the overlap support at 91,855. And this may be a better opportunity to go long on Bitcoin for slightly longer time frame, right? So for more of a short to medium term time frame, if we do see Bitcoin break out of this sideways channel here as identified by the white box, it could stabilize at the overlap support, which is the pivot, and this region here could be a better opportunity to identify a nice rebound for Bitcoin, because we can see that this is a significant overlap where this coin has bounced off multiple times since 26th of November 2024. All right, let's move on over to the commodities, right? And of course, should you have any other requests for the other instruments, right, please do drop them in the chat box, right? I'll be more than happy to go through the analysis with you. But otherwise, let's take a look at the commodities. XTI USD is the instrument that tracks WTI crude oil futures, and we can see that for most parts of last week, crude prices have actually stabilized and climbed higher, right? We actually saw 4 consecutive days of higher prices for crude oil, right? It stabilized at around $70.70 per barrel on Monday, before rising as high as $73.25, right, from trough to peak. We saw this commodity rise more than 4.3%, right? Pretty strong retracement to the upside. However, it stalled at around the $73 mark and dropped sharply on Friday on the 21st, right? Most likely this was the announcement of new trade tariffs, right, which would dampen overall economic growth, and that would also trigger lower demand for crude oil as well. So that's probably one of the main reasons why we saw crude oil prices drop sharply. This is actually a huge dive here, right? When you look at it from peak to trough, we saw crude prices dive over 3.5%, right? A huge move for a single day. This is the largest move, downward move since, I would say, since the first week of February, where crude prices dropped nearly 4%, right? You can see a huge down candle here on the first week of February with XTI USD diving 4%, right? This is another huge big downward move for crude oil as well, right? So we've identified the first support at $69.62. There's a nice swing low being formed here, right? We can see a nice swing low being formed here over Christmas, and it's also a swing low support that's accompanied by a Fibonacci retracement at 78.6%. We found this retracement level starting from this swing low here on 6th of December, going up to the swing high on the 15th, right? So this is where the first support for XTI USD sits at, and we can probably expect this commodity to drop towards this level quite sharply, or continue to drop towards this level quite strongly as markets reopen today. Right, so it's made a bearish reversal of the pivot, right? Last week it made a bearish reversal of the pivot, which is also accompanied by a Fibonacci retracement at 23.6%, and higher up, the first resistance at $73.65 is an overlap resistance that's accompanied by a Fibonacci retracement at 38.2%. Now, these retracement levels were found starting from this swing high on 15th of January, going down to the swing low here on the 17th of February. And take note, should we see crude oil prices break below this low of $70.11, then of course these retracement levels at 23.6% and 38.2% are no longer valid. So take note as markets reopen, and should we see crude prices gap lower, for example, gapping under or below $70.11. Take note that this retracement levels are no longer going to be valid, and we may need to adjust the ending point of the retracement, or we would just probably need to delete it completely from the analysis. Right now, let's move on over to gold. Right, XAU USD is the instrument that tracks spot gold futures, and we can see very clearly since 19th of December, right, 2024, this commodity or this precious metal has been in a very strong uptrend, as highlighted by this ascending trend line as well. As a very strong ascending trend line that's been in place since 31st of December. And of course, at the same time, we can see this commodity continue to trade above the green Ichimoku cloud, highlighting the ongoing bullish momentum. And we can see price clearly rising, and at the same time we also see the cloud, the green cloud, rising up along with it, highlighting the ongoing bullish momentum. Right, this bullish momentum has been in place actually since October 2023 as well. Right, since then we can see gold prices rise very strongly from about $1,830 per ounce, right, to as high as $2,954.94. Right, this was the all-time high for spot gold that was formed as recently as Thursday, 20th of February. Right, it looks to have sort of fizzled out around this level here. Right, so should we see gold prices pull back? Right, should we see gold prices pull back as markets reopen this week? Right, where I see a strong support is at $2,867. Right, this is where the pivot has been identified. This is an overlap support that's accompanied by a Fibonacci retracement at 23.6%. Right, we see previously this level functioning as resistance. Right, this level functioning as resistance on 6th of February, and then making a nice bounce here on the 12th, creating a very nice overlap support, which we can identify as the pivot, and is also accompanied by a Fibonacci retracement at 23.6%. This retracement level was found, right, starting from this swing low here on 18th of December, and of course going up to the record high on Thursday, 20th of February. And beyond that, there's also another nice overlap at $2,787 per ounce. This is also an overlap support that's accompanied by a Fibonacci retracement at 50%. Right, this level here previously functioned as a strong swing high resistance at the end of October. Then we can see resistance being formed again on 24th of January. Then we see a support taking place as well, right, once the bullish breakout took place right at the end of January. This level then proceeded to function as a pretty decent support zone, right? The combination of the ascending trend line and the pullback level identified a pretty strong support zone for price to continue to rise higher. Right, so should we see any deeper pullback take place for spot gold, right, where it's very likely to stabilize is the pivot level at $2,867. This is an overlap support accompanied by Fibonacci retracement 33.6%, and at the same time we can also see the ascending trend line intersecting with this level once more. So this highlights this zone here, right, highlights a very strong support area for spot gold. And should we see this precious metal pull back all the way down, this is where we can expect it to stabilize once more, right? And then this would probably give a better opportunity to go long on gold. And the resistance is identified at $2,973 per ounce. This is a resistance barrier that's identified by Fibonacci projection at 100%. Remember, with spot gold making its latest intraday high last Thursday, right, there's a pretty decent resistance barrier there's a resistance barrier over here as well, as highlighted by the dotted horizontal line at around 2,942. But looking slightly beyond the intraday high, right, looking slightly beyond the intraday high, I've used the 100% Fibonacci projection to identify another resistance barrier. We found this projection starting from 0.1 on 6th of February, going up to 0.2 on the 11th, and ending at 0.3, which is the 12th. So the 100% Fibonacci projection sits at $2,973, which has been identified as the first resistance. Right, before we continue, right, and just for those of you, right, at the same time, please remember to smash the like button, right? Please remember to smash the like button as well. And I'm going to launch a poll as well. Truly appreciate it if you guys can give your feedback with regards to today's webinar, right? Right, okay, before we continue, right, please do remember to smash the like button as well as giving a response in the poll as well. Really appreciate it. And then we'll just wrap things up quite shortly, right? And of course, if you have any requests for any other instruments, please do uh, drop them in the chat box, right? I'm more than happy to go through the analysis with you. Otherwise, we can touch on the indices and then we'll wrap things up for today. All right, okay. So if not, then let's just continue with the indices. Looking at US, let's start with D40, right? Let's take a look at the DAX, right? D40 is the instrument that tracks the DAX futures, and we've seen this European index, right, or this German index, pull back sharply since 19th of February, right? All right, okay. Hi Watson, you've got a request for EuroCAD. Okay, then let's quickly cover EuroCAD as well, right? As we don't have much time. Okay, maybe let's just cover EuroCAD first, and of course if there's still a little bit of time, then we'll come back to the DAX. Let's take a look at EuroCAD. Right, so basically this is the euro versus the Canadian dollar, right? And we can see that, let's see, let me just get rid of this. I'll tell you what, let's just start with a fresh chart, right? So we can see here, right, we're moving in a daily time frame. The EuroCAD looks to have stabilized in the second week of February at around 1.4750, right? And you can see this index has stabilized around here, forming a nice swing low in the second week of February, stabilizing at what is close to a very significant swing low support that was formed in mid-Jan. So very clearly this is where a significant support level sits for this currency pair. So this is where we can identify the first major support, right? This is at around 1.4720. First major support for the EuroCAD is a multi-swing low that has been in multi-swing low support that has been in place since 14th of January. Now higher up, right, it looks to have run into resistance at around 1.4898, right? We can see that EuroCAD has failed to climb above this level since mid-February, and when I look across this level, drag this level all the way, right, it's actually a pretty significant like pullback resistance, right? You see a nice pullback resistance being formed here. So this is where we can identify as the pivot, right? The pivot at 1.4913 is actually a strong pullback level, right? And is likely to see this index, see this currency pair fail over here as well, right? So perhaps we can, should we see the EuroCAD continue to rise higher, this is where it could once again fail and make a small pullback, right? The pivot is a pullback resistance at 1.4913, which should also be accompanied by a Fibonacci retracement. Let's try and find one, starting from this swing high on 30th of Jan, going down to the swing low on the 11th of February, and we can see very clearly the 38.2% retracement aligning very well with the pivot, which is a pullback resistance. And higher up, right, there's another pullback that I would like to highlight as well. This is at 1.5012, right? This is another pullback resistance, which we can identify as the first resistance, and there should be, I believe, 61.8% retracement here. Yep, there we go. There's a 61.8% retracement, aligning very well with the first resistance. And I would also like to uh, highlight this point here, right? There's a intermediate support level at about 1.4813, right? You can see here that Euro CAD has managed to stabilize above this level here on Tuesday and Wednesday, 18 and 19 of February. So take note, there's a pretty decent support level here as well at 1.4807. So after reversing strongly, right, after stabilizing around 1.4750 in the second week of February, Euro CAD has made a retracement to the upside, but has remained restricted underneath the pivot and the 38.2% retracement. So it looks like it could stall around this level once more and make a pullback towards an intermediate support at 1.4807, right? This is an intermediate support level here, and of course the multi-swing low support at 1.4720 is going to be a major area where this currency pair is likely to hold once again in the future. All right, okay, so let's see. Okay, we've covered Euro CAD. All right, if there's no other requests, then let's quickly just come back to the calendar, right? And just do take note, it's quite a busy calendar as well, right? It's several things going on, right? We've got on Monday 24th of February at 9 a.m. GMT time, the ifo business climate for Germany will be released and is expected to show an unchanged figure as well, right? Business sentiment and conditions in Germany hasn't been great throughout over the last 2 years, especially for the manufacturing sector, which has deteriorated quite badly, right? We've seen that sector remain in contraction for nearly 2 years or 2.5 years. And then on Tuesday, we've got a bunch of US macroeconomic data. We've got home prices, the S&P Case-Shiller Home Price Index that will be released alongside consumer confidence surveys. Then we have Australian CPI on Wednesday 26th of February at 12:30 a.m. GMT, right? Take note, the monthly CPI indicator for Australia is expected to show price pressures rising once again. And then on Thursday, on the 27th, at 1:30 p.m. GMT, we have the preliminary GDP result for the US, as well as durable goods orders and Tokyo Core CPI as well for Japan. And finally on Friday, not only do we have Canadian GDP data, and Germany's CPI or consumer inflation data, we also have the PCE price index, which is the Federal Reserve's preferred gauge of inflation. So take note, monthly CPI in Australia has accelerated since October, right, rising from as low as 2.1% in October to as high as 2.5%, right, to an annual rate of 2.5% in December. And we are likely to see price pressures continue to increase for the month of January, rising to 2.6%. And if we do see much higher, if we do see price pressures accelerate even more, right, this result would likely trigger higher demand for the Aussie, and we can probably expect this currency pair to receive a nice boost on Wednesday 26th of February. And then looking at US GDP data, right, if GDP data comes in strong, right, based on the preliminary report, right, if GDP data comes in strong, alongside, this is on Thursday, GDP data is on Thursday, and if we see Friday as well, PCE price index continuing to show acceleration, especially for the headline PCE, right, we could see a strong demand for the dollar pickup, especially in the second half of this week. All right, that's all I've got for you guys today, right? Thanks everyone for tuning in to today's session brought to you by IC Markets. Do look out for all upcoming webinars by IC Markets for the remainder of this week, right? There's going to be a combination of live analysis and educational topics in English, Thai, and Bahasa as well. So do look out for all the upcoming webinars that have been scheduled for this week. All right, thanks everyone. Take care. Have a great trading week, and looking forward to seeing all of you at the next session.